Ladies and gentlemen, what we are witnessing today is often described with a single convenient phrase: a Bitcoin crash. Prices fall, charts turn red, headlines scream panic, and the story seems simple. But simplicity can be misleading. This is not merely a sudden drop in the value of a digital asset. This moment represents something far larger, far deeper, and far more significant than a market correction. For years, Bitcoin has been treated as a symbol. By some, a symbol of freedom, by others, a symbol of speculation. It challenged traditional finance, questioned the role of central authorities, and forced governments, banks, and investors to reconsider long-held assumptions. When something so disruptive shakes, the tremor is never limited to its price alone. It travels through confidence, trust, and the very structure of how we think about money. This moment is exposing the fragile foundations beneath the modern financial mindset. Markets today move not only on value but on belief. Algorithms react in milliseconds, social media amplifies fear in seconds, and narratives overpower fundamentals in hours. When Bitcoin stumbles, it reveals how deeply emotion, leverage, and herd behavior dominate global finance. What we are seeing is not the failure of a technology, but the stress test of an entire financial culture built on speed, hype, and borrowed conviction. It is also a reminder that innovation always comes with cycles of excess and correction. Every transformative idea in history has followed this path. Railways, automobiles, the internet. Each experienced booms that felt unstoppable, followed by crashes that felt catastrophic. Yet those crashes did not end the innovation. They cleared illusions, punished recklessness, and separated lasting value from temporary excitement. What survived went on to reshape the world. Beyond markets, this moment speaks to power. Bitcoin was never just about profit, it was about control over money, transparency, and resistance to centralized manipulation. When volatility strikes, it forces a global conversation about who controls wealth, who sets the rules, and who bears the risk. Governments respond with regulation, institutions reconsider their exposure, and individuals question their trust. That conversation is far bigger than any single asset's price. This period is also revealing a generational shift. Younger participants entered financial markets through digital platforms, crypto exchanges, and online communities rather than traditional banks. For many, this is their first encounter with large-scale loss and uncertainty. Painful as it may be, it is shaping a more mature understanding of risk, patience, and long-term thinking. Markets educate brutally but effectively. So let us be clear, this is not the end of an idea. It is the end of certain illusions. The illusion that prices only go up, that risk can be ignored, that innovation replaces discipline. What emerges after moments like this is often stronger, more grounded, and more resilient. Technology continues to evolve, systems adapt, and lessons are absorbed by those willing to learn. History will not remember this moment simply as a crash. It will remember it as a turning point, a moment when speculation met reality, when belief was tested, and when the world was reminded that true transformation is never smooth. Progress is messy, uncomfortable, and often misunderstood in the moment. Ladies and gentlemen, this isn't just about Bitcoin falling, it's about a global financial awakening, a reevaluation of trust, and a reminder that real change does not arrive without turbulence. What matters now is not fear, but understanding, not panic, but perspective. Because something much bigger than a crash is unfolding, and how we respond to it will define what comes next. What appears on the surface as a simple fall in Bitcoin's price is, in reality, a reflection of a much deeper transformation in the way the world thinks about money, value, and financial systems. For years, Bitcoin has existed at the intersection of technology, ideology, and economics. Its rise was not driven solely by its utility as a digital currency, but by what it represented: independence from traditional institutions, protection against inflation, and a new financial order, powered by code rather than authority. When its price declines sharply, it signals more than market weakness. It reveals tension between old financial structures and emerging alternatives. This moment highlights a global reassessment of trust. Investors are questioning not only whether Bitcoin is valuable, but what value itself truly means in a digital age. Is value determined by scarcity, by utility, by belief, or by collective agreement? Bitcoin forced these questions into mainstream conversation, and its volatility now shows how unresolved those questions remain. The uncertainty surrounding its price mirrors uncertainty about the future of money itself. At the same time, this shift exposes how interconnected modern financial systems have become. Bitcoin is no longer isolated from traditional markets. It moves alongside stocks, bonds, and global risk sentiment. Its decline reflects broader anxieties about economic stability, interest rates, regulation, and geopolitical uncertainty. In this sense, Bitcoin has become a mirror of the global financial mood rather than an escape from it. Ultimately, this is a moment of transition. The dramatic movements in Bitcoin's price mark a phase where excitement gives way to evaluation, and blind optimism gives way to critical thinking. The world is not abandoning innovation, it is learning how to place it within a realistic framework. This shift in mindset is far more significant than any temporary price movement, because it shapes how future financial systems will be built, trusted, and sustained. The current situation lays bare a reality that many prefer to ignore. Modern financial markets are driven as much by emotion as they are by logic. Fear, greed, excitement, and panic move faster than data or analysis, and Bitcoin has become one of the clearest examples of this phenomenon. When prices surge, optimism spreads instantly, convincing participants that risk no longer exists. When prices fall, that same crowd rushes for the exit, often without understanding what has fundamentally changed. This behavior reveals how psychological forces dominate decision-making in today's markets. Technology has amplified this emotional cycle. Algorithms execute trades in milliseconds, reacting not to long-term value but to short-term signals and momentum. Social media platforms magnify every price movement, turning rumors into narratives and narratives into market-wide reactions. A single tweet, headline, or viral post can spark waves of buying or selling, creating volatility that has little connection to real economic conditions. Bitcoin's rapid swings highlight how fragile markets become when speed replaces reflection. Speculation also plays a central role. Many participants enter the market not to invest but to chase quick profits. Leverage allows traders to control large positions with small amounts of capital, increasing gains during rallies but magnifying losses during downturns. When prices begin to fall, forced liquidations accelerate the decline, creating a self-reinforcing spiral. This chain reaction exposes how much of the market is built on borrowed confidence rather than solid fundamentals. In this environment, fundamentals struggle to be heard. Long-term factors such as technological development, security adoption, and real-world use are overshadowed by short-term price action. Bitcoin's movements reveal a broader truth about global finance. Markets are no longer calm evaluators of value, but emotional ecosystems where perception often matters more than reality. Understanding this dynamic is essential to grasping why price crashes occur so suddenly and why they often say more about human behavior than about the asset itself. Bitcoin's extreme volatility is revealing how much of the financial world is built on trust and belief rather than certainty. As a decentralized system, Bitcoin does not rely on a central authority to guarantee stability. Instead, it depends on collective confidence in its technology, security, and long-term relevance. When prices fluctuate sharply, that confidence is tested in real time. Investors are forced to confront whether they truly understand and trust the system, or whether they were simply following momentum and popular opinion. This stress test exposes the strengths and weaknesses of decentralized finance. On one hand, Bitcoin continues to operate exactly as designed, regardless of market panic. Transactions are validated, blocks are added, and the network remains functional without intervention. On the other hand, price instability highlights how difficult it is for a system based on freedom and independence to coexist with expectations of stability and predictability. Many participants want decentralization in theory, but reassurance and protection in practice. The volatility also forces comparisons with traditional financial systems. Banks and governments often step in during crises to stabilize markets, but Bitcoin offers no such safety net. This absence is intentional, yet it challenges users to accept responsibility for risk. In doing so, Bitcoin's price swings are not just market events, they are real-world experiments testing whether society is ready to trust financial systems that operate beyond centralized control. Periods like this are a natural part of the life cycle of every major innovation. When a new idea enters the world, it often arrives with extraordinary promise and even greater expectations. Bitcoin, like many transformative technologies before it, experienced a phase where excitement ran ahead of reality. Rapid price increases created the impression that growth was guaranteed and risk was minimal. This environment encouraged speculation, exaggerated claims, and the belief that traditional rules no longer applied. Such phases are not signs of strength alone, they are also warnings of imbalance. The subsequent downturn serves a critical purpose. It forces the market to confront reality and reassess what truly has value. Projects built on weak foundations, unrealistic promises, or pure hype struggle to survive when easy money disappears. At the same time, ideas with real utility, strong technology, and committed communities are tested rather than destroyed. This process of correction helps strip away excess and brings clarity to what can endure over the long term. History offers countless parallels. The early internet boom was followed by a devastating crash, yet the companies and technologies that solved real problems went on to define the modern digital world. The crash did not eliminate innovation, it refined it. In the same way, Bitcoin's current phase is not erasing its potential, but filtering out unrealistic expectations and speculative noise. Through this cycle, the market matures. Investors become more disciplined, builders become more focused, and conversations shift from rapid profits to sustainable development. What remains after the hype fades is often more resilient and meaningful. This separation of lasting value from temporary excitement is uncomfortable, but it is essential for any innovation that aims to survive and reshape the future, rather than merely capture attention in the present. This moment has intensified a global debate about power, control, and the true ownership of money. Bitcoin was created as an alternative to systems where financial authority is concentrated in the hands of governments and central institutions. Its rise challenged long-standing structures by offering a form of money that operates beyond borders and outside direct state control. When volatility strikes, it draws attention not only from investors but from regulators, policymakers, and institutions that feel their influence being tested. As prices fluctuate, governments are compelled to respond. Some see the instability as proof that tighter regulation is necessary to protect citizens and maintain economic order. Others recognize that heavy-handed control could stifle innovation and push financial activity into less transparent spaces. This tension reveals a deeper struggle between freedom and oversight, innovation and stability. Bitcoin's behavior forces societies to question how much control is appropriate and who gets to decide. At the same time, institutions are re-evaluating their roles. Banks, payment networks, and financial intermediaries must confront a future where their dominance is no longer guaranteed. Bitcoin's volatility does not weaken this conversation, it amplifies it. The debate over regulation, sovereignty, and financial authority is no longer theoretical. It is unfolding in real time, driven by a technology that refuses to fit neatly into existing power structures. This phase is proving to be a defining educational experience for a new generation of investors. Many participants entered financial markets through digital platforms, mobile apps, and cryptocurrency exchanges, often without prior exposure to prolonged DAO and turns. For them, rapid gains felt normal, and risk seemed distant or manageable. The current volatility has disrupted that perception, introducing lessons that no textbook or online course can fully replicate. Losses, uncertainty, and emotional pressure are teaching realities that markets reward patience and punish overconfidence. This experience is reshaping attitudes toward risk. Investors are learning that price movements are not guarantees of future performance, and that diversification, research, and restraint matter more than excitement. The idea of quick wealth is giving way to an understanding of cycles, timing, and long-term commitment. Many are discovering the importance of capital preservation, realizing that surviving market downturns is as crucial as profiting during rallies. Emotional discipline is another powerful lesson emerging from this period. Panic selling, impulsive buying, and constant chart watching often lead to poor decisions. As investors experience the consequences of emotional reactions, they begin to appreciate the value of strategy, planning, and emotional control. This shift in mindset represents real growth, even though it is shaped by discomfort. Over time, these lessons contribute to a more mature financial culture. Investors who endure this phase emerge with clearer expectations, stronger resilience, and a deeper respect for uncertainty. While the process is painful, it is formative. It transforms participants from spectators chasing trends into informed decision-makers who understand that meaningful success in financial markets is built slowly, through knowledge, discipline, and experience rather than hype or hope.